Welcome back, everyone. As we continue to preview this week's FOMC meeting, let's welcome in our first guest this morning, who is still on team 75 basis point hike, despite the chances of a full 1% hike still looming somewhat. Joining us now is Interactive Brokers Chief Strategist Steve Sosnick. Steve, always a pleasure to speak with you and get some of your insights. All right, so break down exactly where your own shift has been. Previously, you were talking about don't fight the Fed, sell the rips, expect volatility. What are you expecting now?
Good morning, Brad. Pretty much the same thing. My rationale behind don't fight the Fed is the Fed was a tremendous friend to markets through basically most of the last decade and a half, but particularly the 2020 and 2021 periods. Now they're taking liquidity out. We haven't seen a period of that. So if don't fight the Fed meant go along with the Fed's liquidity additions for years, now you have to respect the fact that they're removing liquidity. As a result, buy the dips, switches to sell the rips, and you continue to see volatility. So far, that's been pretty much the case. We've had some bounces, but I'm going to have to say the thesis is largely holding.
I'm going to put you on the spot in terms of market history here for a second, Steve. What tends to happen during a tightening cycle? In other words, how long can tightening go on, and how much in advance do stocks tend to bottom and start to rally?
Stocks, it's funny, monetary policy is one of the few things that stocks tend not to be very good at analyzing. At digesting in advance. They tend to react to changes in liquidity. Even in March, we were in March of 2020, we were plunging, and the Fed was massively adding liquidity. It took a few weeks for the market to turn around. That's kind of what we're seeing. That's kind of what we see. When we look back, the Fed raised rates and reduced the size of its balance sheet in the fourth quarter of 2018. That was a disaster for the markets. We fell about 20% in 3 months. Finally, we stopped falling and bounced a bit when the Fed said we're done raising rates. They continued to reduce liquidity. Actually, in a strange way, that was good for stocks because they didn't notice that there was a crisis in the repo markets, which led the Fed to turn around and start adding liquidity again. You could look at other periods, 2006, 2007, where the Fed was restrictive, 2000, 2001, where the Fed was restrictive. Those should probably resonate as not particularly great times for markets. And this is why this is why I'm very nervous about the stock market and risk assets overall, as long as the Fed remains with its foot on the brakes.
75 basis points, widely expected here. So for the markets, are they still pricing in that 20% looking like chance of a 1% hike? And would it just be relief if we only saw 75 basis points, even if we did know that the pathway forward still means that the Fed might have to be aggressive at their next meeting as well?
I do think you can get a bit of a relief rally. You guys had the graphic up before that I'd sent over with the market reaction. I look at the 3-day period surrounding a Fed meeting, sort of the Tuesday close. The meeting's typically Wednesday, Tuesday close through Friday close. So that encompasses the Fed meeting and a little period to digest. What's been fascinating is as we were ripping higher in 2020 through the 2021 period, most of the post-meeting reactions were negative, despite the raging bull market, because the Fed was never as enthusiastic as the market wanted them to be. Since September of last year, when the Fed started to change its rhetoric, we've seen a lot more bounces in the post-Fed period because people have gone in with this negativity, and Powell has been somewhat conciliatory in the face of it. So we've seen kind of a mixed reaction, but some of the bounces have been substantial, as you see on the screen, in March and at the last meeting. So I do think you get a sense of a relief rally if we continue to sell off into Wednesday, today and tomorrow, when that 20 basis points is taken off the table. But the question to me remains what he says at the press conference. He's left a lot of wiggle room at each of the last press conferences. The last rally was him saying, we're at a neutral rate, but we hope to go restrictive or tend to expect to go restrictive. Market heard neutral and loved that. And markets are looking for the next pivot. And that's kind of why we continue to rally until Jackson Hole, when when Powell said, no way. And he more or less repeated that rhetoric recently. And so the question is, does he have the conciliatory tone, or is he willing to continue to keep messaging that, no, we're not pivoting anytime soon until we get inflation under control. And just because it goes from a very high number to a less high number, it's still well above our target. And that's really how the market takes that is really going to be the question.
And one of the other questions that's developing right now is around valuations. I earlier quoted from a note from Lori Calvasina, who said valuations are starting to maybe look attractive here, but we're hearing from some other folks this morning who are saying they are not, including strategists at Morgan Stanley and Goldman. What's your view of what the market's pricing in right now? And I mean, I guess if you're still in the sell the rips camp, you don't think the valuations are terribly attractive.
I think selectively we are finding some, but that's you're looking sort of for nuggets amidst a larger pile of earnings. The FedEx news to me was bad on so many levels, because FedEx is really everything needs to be shipped at some time or another that's in the economy. Unless you're buying at a local farm stand, you pretty much have to ship the goods from point A to point B. And if FedEx is seeing trouble in that regard, some of it was company specific, but a lot of it was economy based, and that's not a good sign. Which puts me sort of more in the camp of the guys who think that we're getting closer to fair value, but we've got a ways to go, because I do think that it'll be critical what we hear at the next earnings season in a few weeks. Do companies start to guide lower again? Are the earnings disappointing? I don't want to put the cart in front of the horse. We're a few weeks away from that, but that's really going to be the tell. I tend to think that we're going to hear some sobering news from companies about their forward outlook at the next earnings cycle, and that kind of bodes toward the second camp.
All right. Well, we'll keep in touch and talk about it as it all goes on. Steve Sosnick, Interactive Brokers Chief Strategist. Thanks. Appreciate it, Steve. Good to see you.
Thanks, Julie. Take care.